Markets rally on Fed announcement. What does that mean for you and your money as we head into the year end? That's coming up next. Yesterday, the Fed announced that they're going to double the rate of taper and they're going to start to move up their rate hikes, doing 3 rate hikes in 2022, 3 in 2023. Of course, very likely we'll see them even raise rates faster if inflation continues to be a problem. But yet the markets, despite this more hawkish attitude from the Fed, the markets rallied sharply yesterday, actually closing up right at all-time highs here, back at that resistance level. Now this morning, futures are pointing higher. We're going to see the markets try to rally up to 4,700 here over the next few days, particularly if we do get a sustained breakout above these recent highs. In the short term, though, markets are very overbought. So again, that does potentially limit some of the upside here in the near term. But we'll see how this works out over the next few days. Of course, right now we've had a lot of selling here over the course of the last few weeks, and that's really been that mutual fund distribution that we've been talking about. Now these mutual funds have a lot of cash on their books that they need to put back to work. So that's going to help support some of the buying into year end as we begin to kind of see that. So again, that money's going to come back in. They want to rebalance their books to make sure they have all the hot stocks on their books. This is called window dressing. So when they provide their annual reports, they're going to show what positions they own on their books. So they want to make sure that they show that they've owned all the hot stocks this year. Looking forward here, though, our money flow signal is still positive here. That's good. That supports this little buying attitude. One of the things that we've been concerned about here lately, though, continues to be the lack of volume. Even though we had this very strong rally yesterday, volume in that rally was very weak. Breadth continues to be somewhat of a concern here. And money flows also continue to really be fairly weak. They are starting to turn up here a bit, but again, not what you would expect with a market testing all-time highs. You would expect a market to have a lot more conviction behind that rally. Just not seeing that yet, and that does leave us some concern moving into the end of the year. Markets are set up now for this kind of end of the year rally. So again, we've been positioning for that during this recent spate of weakness. We've been adding trading positions in the S&P 500. We've added to some of our technology positions as well. Those have been performing well here over the last few days. We expect that to continue as we move into the first 5 days of January. That's also a conducive period as mutual funds are positioning themselves for the new year. So we see a lot of buying, a lot of tax loss selling that occurred in December. Those get put back on in the new year. And then that potentially leads us into the rest of the year where we're going to be a little bit more cautious about outlooks. A lot of headwinds coming our way, tighter monetary policy, weaker economic growth, shrinking profit margins, less liquidity in the system from both a fiscal and monetary basis. Those headwinds that were previously tailwinds are likely going to suppress returns next year in the market. So again, something we'll talk about later here, but that's 3 minutes on markets and money for today, and we'll see you back here next time.